Good morning, everyone. Welcome to the course on financial data science. If you look at the word combination financial data science, you basically see that the course is about the science of financial data. So I think a question comes up, why does finance need its own science data class, right? In business economics, I'm not aware that we have accounting data science or marketing data science. Now, there are different reasons of why financial data is especially interesting, and it's so interesting that it deserves a full course on it, at least one course. And that is what I'm going to reveal in this class. I want to reveal, on an introductory level, the science of finance data. So on the one hand, finance data is less predictive than in typical science disciplines. So that is something why taking off-the-shelf machine learning algorithms perform not as well as you would expect, and they perform better if you include some economic regularization. So these are also things we talk about in the class. On the other hand, there's also finance data on which you can trade directly, which is also very unique. If you have a view on growth, on the standard deviation of something, on where the price is going, you can directly trade on it. And if your view is correct, you make money. If your view is wrong, you lose money. If your view is correct, you still might lose money because of new information coming in next period, which has to do with what I said before. It's very difficult to predict the financial price next period because prices are driven by new information, which we cannot predict. So therefore, financial data science is a very useful course for everyone who's interested in finance. And I think we are all interested in finance, since somehow we have to invest the rest of our human capital, whether it's as an employee or maybe you get funds from your parents or from whoever. Usually we are investing that money. So therefore finance is at the heart of, it is the heart of any capitalistic system. So, and even if it's a non-capitalistic system, it's all about money, right? So this course is very useful for everyone. Now here at KIT, it will be a bachelor's course. You get 9 ECTS for that. Now let's talk about me for a moment. So I'm your host during the lecture. My name is Maxim Ulrich. You can reach me best via email. So if you want to set up an appointment, just send me an email. I respond very fast. And most likely I then send you another link so we can have a meeting the next day. At least that's what I'm aiming for. Now, a short biography, which I always enjoy if I'm in the audience, to get to know who's the person who talks to me and what's their relation to the topic. So I did study business economics, and after that I've pursued a PhD in economics, and there I did specialize in financial engineering, in macroeconomics, and numerical mathematics, basically. So that kind of shaped my teaching and also my research interests. From 2008 to 2013, I went to Columbia Business School in New York. Hi. Yeah, I'm very glad. Welcome. So, right, and there I was in the empirical finance group, teaching MBAs, executive MBAs, and PhD students. I also did teach in industrial engineering students. So kind of shaped my love for teaching financial concepts for engineering-minded students. So in 2014, I went to the KIT, came back to Germany. So here I have the chair for financial economics and risk management. The KIT also has a business school, the Hector School, and there I'm the head for program development in the financial engineering track for the executive MBA. Now, in terms of outreach, I've been founding also 3 firms, but I'm closing them again, which 95% of all foundations are doing, so failure is part of the process. I also consult to and with asset managers and hedge fund managers on topics related to what we are teaching here. Yeah? So financial economics, econometrics, financial machine learning, and option analytics. And I also did contribute to a podcast, KI in Asset Management. I might send the links around, haven't yet prepared it. So that's for industry people. But I try to make it fun and make some relations to KIT, so I think at least 1 or 2 of them are pretty funny. Good. Maybe before we move on to the Python focus session, just a quick review of who's in the audience. Who studies industrial engineering? Okay, who studies computer science? Who studies something else? What do you study, for example? Oh, I see, that's informatics, very good. Okay, thank you. Good. Now, your host for the Python focus session, traditionally it's called a tutorial, but this is different than a tutorial. In a classical tutorial, you are repeating and practicing things from lecture, but what we are doing here, in order to focus on financial data science, we want to teach you to work on financial problems with big data sets. Right? We assume you know nothing, but at the end of the course, I promise, if you stick on it, you study for it, you apply to any type of internship or job, and they will ask you for some example code, you send what you've done, and they will call you immediately. That is what we've experienced in the past. It just has to do with what we are solving here is even more industry relevant than what we've done in the past, because in the past we stayed close to lecture. Here we also stay close to lecture, but we will expand, and you will solve problems here in a guided environment that the top firms are also solving. And the not so top firms, they don't know how to solve it, so you will be their consultant. The chain is very simple there. Now, your host, that's why I like to call it Python focus session, because that will be the focus, just Python. And you have 2 hosts in that. One is Ardalan, and the other one is Maza. So they're both from Iran, Persia, and they are at KIT maybe for 1 year now. So I want you to be very friendly to them. I'm not sure how many Persians you have ever met. Both are very friendly, very, very well educated, and they are highly determined to make an exceptional Python focus session for you guys. Right? So they are there for you. Now Ardalan, he has a bachelor's and a master's degree in electrical engineering, and the focus is on optimal control. He also published his master thesis in one of the top journals in engineering, and it's in the 90th percentile for artificial intelligence, according to the Google metric, which I checked once. So yeah, he's a very good scholar already, and his interest coming from optimal control is end-to-end reinforcement learning, which will also be at the very end of our class, 2 classes on that. So you see from that already that finance is, I think it's the best application for engineering-minded students who want to go away from pure engineering and look for an application. It's very common that you have mathematicians, electrical engineers, economists, statisticians, right? So whoever has some skill in a field finds its place in finance, and finance is also compensating very well. It's challenging and rewarding because you always work on the edge. I have a bit more to come on that, but you see it already on the profiles of me versus the tutors, for example, 3 people, 3 different backgrounds, all doing research in the same field. Now the second tutor is Maza. She has a bachelor's in software engineering and a master's in information technology, and her interest for research is financial machine learning, financial data science. So what we will also do in the focus sessions, from time to time, other PhD students from our AI finance group will also join as co-hosts. And that has to do with the fact that when you solve a problem set, which we grade, you will get a ton of code to start with. That allows you, of course, at the end it allows me to fulfill all my promise that at the end of the course, you will have worked on things which to an outsider looks like impossible. It has to do with the fact that several facts. Once, you're very well qualified. Second, I give you additional qualification. Then third, you learn during the tutorial, of course, and then you are starting off with the code base in most of the projects. And that code base is usually related to a research one of the PhD students is working on, and therefore they would come, introduce you to the code, and so on and so forth. Right? That's the reason we try to involve everyone who could increase the value for your learning. Good. Now, the audience, we are in a very big room. Was the only room available, so but it's cool. We have a microphone, we have a big screen over there, so I think everything is good. The core audience for the course would be the bachelor students taking the class for credit. We have enough space to also welcome students who are just like to sit in. Now, on the note, if you have a friend in the master's program and you want to do them something good, recommend the course, because the KIT wanted that we teach such a course in the bachelor's, so therefore it's not in the master's anymore, or it will never be in the master's. But the material that's covered here is very essential, and I argue it's hard to get somewhere else. So therefore, we also welcome master or bachelor students who just take it for their pleasure. Now, lecture time is Monday 8 to 11:15 in this room. Then the Python focus session is on the same day. It's a different Hörsaal. You have to check where that is. I didn't. I think it's not so difficult. So the good thing is, just prior to lunch, you've already completed one module, basically. That also was our goal, so it's very efficient. Now, in terms of grading, what we will do is, we do not have an exam, but we have 7 problem sets, and the 6 best of your solutions will be used for determining your final grade. Now, with every programming-oriented testing, we want that everyone achieves 100%. Because if your code is correct 98% of cases, it still doesn't work. Right? That is the problem. So you can also team up for a group of up to 3 students. Once we have the first problem set come in, we provide more information on how we do that organization. But intuitively, you can team up with different teams on a problem set basis. We will record your matriculation number. So it's all very student friendly. Here's a schedule that kind of summarizes what is the room for which date. So whenever you have doubt, you could check in here. And this is the agenda for my lecture. Wait a minute. Yeah, awesome. Okay, agenda for my lecture. So, what you see is we kind of have 13 meetings. And before I go towards the topics, in terms of the type of teaching I'm doing here, you see kind of per meeting I have roughly between 20 and 50 slides. So let's say if we have 50 slides like today, it's basically baked in a 30-minute discussion within these lectures. Right? So always feel free to ask anything related to data science, financial data science, of what we've had or what we just have. If you think you just lost something, just raise your hand and let me know. We also have a Python material in the lecture. That has to do with the fact it's a data science course and not a theory class, and that's why there will be Python even in lecture, although the focus session is exclusively Python. We also have some case studies, especially in the beginning, to help you get started with thinking in financial economic terms. You also see we have a few lectures kind of towards where the first problem set is going to happen with only 19 lecture slides. The reason is I will do live coding in that session as well. Right? So you have enough time to pick up coding because I have Python examples here. They are fully developed, but I don't give you the source code because I invite you, if you're new to Python, the data set is in the lecture folder on Ilias, and you can just open your Python and then recompute what I've been computing, and that way also get used to Python. If you know that already, then you don't have to do that. The live coding I will do several times, like I do it when we run factor regressions. I will also do live coding when we estimate or when we learn parameters of a neural net. We have one session which is a bit more mathematical, so I will use the blackboard to do the math on the board. So also there we just have 24 slides, so we have enough time. Okay, so what are we going to do in that course here? Now going to the topics. Well, today I do motivation, and we start off with valuation. Yeah? How to value what's the price of a project? And what is a project? A project is something that has the potential of giving me some dividends, some payoff in the future. Yeah, and what's the value of that? So we are starting off with that. We also do a little Python introduction. Then starting next meeting, we do portfolio allocation. So the mean variance Markowitz approach that received a Nobel Prize. So we are starting already next week with Nobel Prize concepts. The week after, we do then the Python for portfolio allocation. Right? First the concept, then the Python, and we then start with another concept, the CAPM. So it's about how to compute expected returns that you, for example, use in order to compute the value of a dividend stream or of a cash flow stream. Yeah? That's how we connect back. These topics here are very closely MBA related. So I've been teaching that at Columbia Business School as well. I think it's the most important for engineers, for people who haven't had 2 finance courses before, but we assume you have no previous knowledge, and kind of these 3 meetings bring you towards a knowledge level that every MBA of top universities has. Now, then we continue doing the Python, how to compute these CAPM expected returns. Methodologically will be regression, so we run a static regression, we run a rolling window regression, and that we do in class. And then you see now the slope steepens. Mart is already meeting 5, so it's like a month later. We then start with risk management, and risk management is about, first I need to quantify risk, and risk as a first approximation is standard deviation of a random variable, variance. We also call it, or the square root of it, so it's volatility. So here it will be about how can I estimate volatility? Of course, the basic thing that maybe accounting does is you have a time series of returns, put it into Excel, and you get the sample standard deviation. Right? That's an unconditional estimate. What we are doing is time varying estimates, conditional ones. So we will use the Garch model. And then we use the stochastic volatility model, so it's not a machine learning SVM, it's the stochastic vol model. We will introduce the models in the concept or in the context of risk management, so estimating the variance of returns next period. It's like the second moment, basically, of the return density. And we will do that using maximum likelihood and also the Kalman filter. Yeah? So you see already here the concepts. We have follow-up statistics classes at KIT who just focus on the Garch for a full semester. Yeah, so I highly recommend, if you're interested in that, do that. There are machine learning classes who might also for sure talk about Kalman filter. It's a standard tool there, but we just use it already pretty early because we need it. And we are not focusing on convergence proofs and the like, but we just want to understand what is it, why does it work, and how to get it to work, and how to interpret results. So I also do some part live coding here. Then the course is financial, or the science of financial data. So therefore we will have a full day where we talk about tradable financial data. That's typically something you don't talk about in finance. I also never had a course on that. You just have some theories and then you're out on your own and you have just no clue really where to get data from, what is good data. So we have a full section on it. And we focus on finance-related data that you can directly trade on. Yeah, so that's really useful for your own trading and for, of course, also research, portfolio decisions, risk management decisions. Okay. And then, in terms of difficulty, we are kind of we stay with a slightly increasing slope, but in terms of novelty of topic, the slope goes up. So here's a topic that I don't think you find anywhere worldwide. I mean, for sure not in the bachelor's class, maybe in the master's, PhD class somewhere. But again, we don't do it in terms of the proofs here. We just, again, what's the idea and what do I get from that? So we will talk about option-implied risk-neutral density functions. So you will learn by then, if we talk about risk management, kind of that typical predictions in all science disciplines, same in NLP, large language models, it relies on backward-looking data. So therefore, what you are learning is whatever you have seen in the past. Now, finance is a very agile field. Think about COVID. You've been running all your estimations prior to COVID, and something like COVID hits, which never did hit before. So it hasn't been in your training set. So therefore, your machine, your model has no clue at all, and just assumes something is going to happen, but it's not as severe as what happened during COVID. That's a typical problem of using backward-looking data to learn. And in finance, in addition, we have these regime shifts. Yeah, now you have Trump. Trump makes a very different policy which affects stock markets, volatility very differently than when Biden was in office. Right? So here you can really pinpoint to the regime shift. Therefore, everything you've learned, let's say within the Biden regime, has lower information than in order to predict what's going to happen in that regime. Now, there's a very nice mathematical and it's very intuitive relationship between option contracts and the priced-in probability density function for the underlying. That is kind of known since the 1970s when the engineers came into finance, like electrical engineer or the physicists in the 1980s. And what has been a vivid area of research has been to make it operational, make it scalable. And we are working on that in our own research. So we have a database up to millisecond frequency and what it allows us, if let's say you're interested in buying BMW for whatever reasons, BMW stock. Now, if you want to do it in an academic way, or not say academic, in a systematic way, you would try to predict what's the density of BMW, is the expected return positive, what about the variance and the like. But what you can also do is you can look at the option prices on BMW, so we will talk about what that really is, and using some interpolation and extrapolation, which needs to be accurate, you can extract out of that what did the option traders price in terms of the density for BMW over the next day, next 2 days, next 3 months, and so on. Now, research has shown over the last 10 years these predictions are very accurate. Right? And there's an intuition for that. Because if you are just buying, let's say, a BMW stock and you don't check for 10 years what's happening, the chance is pretty high you make a profit within the 10 years. Right? So you can be pretty uninformative when trading stocks. Now for options, it's the opposite. If you buy an option, on average, you're losing money. Yeah, there's a theoretical reason for that, and there's also empirical evidence for that. It just means that, or it implies, plus a second observation, in options you can trade with capital you don't have. It's baked into the option contract. Which means if you have information, you want to trade on something where you get the most outcome for what you invest. And there the option is beneficial. Now both of them, both of these settings together lead to the observation that information goes first into option markets. And from option market, it flows into the stock market. Right? And that for me is kind of the underlying rationale of why we observe that these option implied densities, and out of that we are so informative about what's happening in the stock market in the future. And if you have the density, you have the first moment, the second moment, which is variance, you have the third moment, skewness. Now you can directly trade on this, on the, let's say CBOE, you can directly trade on the variance of the index. Now you can also directly trade the skewness of the index. Yeah, so again, you see why finance is such a spectacular field. Because we are not just, I mean, we start off, at least that's what I've learned from the US. When I was in Germany, we just did the concepts, but when I went to America, I saw these guys are really living these concepts, right? Because the first question they have is how to make money with all of that. And you see how fast the process is, that something gets developed in finance, the researchers like it, then there's exchange with industry, and maybe 2, 3, 4, 5 years later, exchanges are offering some products which relate on these algorithms. And for option implied densities, that has been the case for the second and the third moment. You cannot yet trade the fourth moment, but you can replicate it yourself. But that is something that's going to come, right? And we will talk about these option implied densities, and you will also get a big data set of option implied characteristics for all the stocks of the S&P 500, and you will work with that in a problem set, right? And that's what I meant. The industry people, they don't have that data because there's no commercial provider who provides that data. Therefore, I was so bullish on my very first statement, right, with regard to okay. What else? Then we, once we talk about these option implied densities, we are ready to do some, or to think about machine learning, because now we have very strong features, predictive features. Yeah? But we keep the machine learning small at the moment. It's a bachelor's class, and it's about introducing concepts. So what we do is, I have some Python where I show you how the option depends on the stock. So that way we get some intuition on relationships. And then we move into artificial neural networks to predict the next day's price of an option. Yeah, then that is this live coding thing which we do. You will see even it's not too many lines of code. Once the concept is clear, that is kind of well manageable. Now, given that we are predicting option prices or option returns, to be clear, we could have predicted something else, but of course I chose option prices here to make the course pretty interesting. It then invites us kind of to think about what does a trader on Wall Street know about option pricing, about Black-Scholes. Now we have an option pricing class at KIT. It's a full semester one, which I recommend you visit if you get interested in that. What we do here is just a trader's view on the Black-Scholes model, which has been another Nobel Prize. The Gauge models here has also been a Nobel Prize in financial economics, so this is a Nobel Prize course, basically. Now you see this Black-Scholes thing, I will do the mathematical stuff on the blackboard to keep it or to maximize intuition. And then we move on to machine learning portfolios. So I basically introduce you to the state of literature in terms of financial machine learning. Yeah. So we will look at papers for predicting stocks, for predicting option returns. They have a tapestry of different supervised learning algorithms, boosted tree up to neural networks. And you will also have a problem set on that. Yeah, so you kind of see how lecture and the problem set move along, and why you do your friend in the masters a favor to tell him or her, because this will be great learning for everyone involved. Now then we move on inside the literature, then we focus on the next more exciting machine learning portfolio construction approach, which then relates to deep learning and which uses economic regularization. So you will really see that using economic thinking, if it's good thinking, it's a good regularization and it improves the performance. And then so here we will talk about a paper which predicts daily stock returns of the S&P 500 constituents, and it uses convolutional neural net and the transformer for the time series prediction. So we have this here. And then the last two sessions will be on reinforcement learning. So we start with a research paper, which we present from my former colleagues at Columbia in the engineering department. They basically rely on the mean variance approach here. Yeah, so we are starting then to connect really back to our beginning. So the modeling really relies on an economic framework, which is here mean variance, and then it's adding predictive features from machine learning and builds everything together to an end-to-end portfolio construction. Now, end-to-end means you just get data, you prepare your data to make predictions, and then you make a decision based on your prediction. And this is all connected with each other. Typically in finance, you do first a prediction that is learned, that is trained, stop, and based on the prediction, you make an action. Yeah, but end-to-end works differently. End-to-end allows, if your decision later is a bad decision, then it also has the degree of freedom to change your prediction. And that is something used for self-driving cars, for SpaceX and the like, yeah? Because you want to connect these two dimensions. And with this one paper, we show you how this can be done. And then we talk about kind of new developments in this model-based reinforcement learning for finance, and we will there rely on Ardalan's research expertise. You will meet him in the after the session for the Python part. So you might already notice then he is on fire when it comes to model-based reinforcement learning. Good. So you therefore maybe as a sum up, we start with MBA-like finance. We also add in already Python, which the MBA programs in the US are also including into the MBA schedule. And then we move on towards more the engineering aspects of financial data science with the risk management part, with the view on novel and useful data, and then learning also quite a bit about trading options. And I mean, just statistically speaking, most likely at least one person in the room is trading options because it's very prominent among the young generations. I also thought that is another reason why we should focus on options instead of just stocks. Now here's the agenda for the Python focus session, and this is also important for the grading, because the grading is based on the problem sets. Yeah? So what you will do today in the Python focus session, Adela and Marza, they will help you to set up the Python, assuming you haven't done that. So it's the Anaconda and the PyCharm IDE, quick introduction into Jupyter notebooks and into some of the Python libraries. There will also be, according to schedule, some first application and a refresher of the OLS MLE solutions. Something you have seen in statistics. And then they move on next week. The Python will be on efficient frontier, so that's related to portfolio management. So in the morning I do portfolio, and then right afterwards they do the Python for that. You also will have a Python implementation for maximum likelihood of Gaussian models. That's why today is the recap in the tutorial. And then day after, you see that then there will be then we are building on it. Then we do MLE for Armor Gauge. They will be hit by Gaussian shocks, so therefore it really relates back to MLE of the Gaussian models, and you will see how it works and how we can extract a forecast for the variance of the time series. And then also the first problem set will be coming out. The first problem set is on asset allocation, which is fair because we have just talked about asset allocation for the last 3 meetings. And you will have 2 weeks. So the problem set will be due on the way to read the column. Its deadline is 7:59 a.m. So it's just 1 minute prior to 8 in the morning of that day. Yeah? And once the problem set gets handed out, we will tell you how to upload and the like, and how to submit, and so on and so forth. Okay, and then you basically see the week after, the Python's focus session is reserved for any type of questions that groups might have on the problem set. Right? If there are no questions, there's not much going on. If there are many questions, then a lot is going on. Yeah? So again, it's just to help you to succeed with 100%. That's our ambition here. Then we have the second problem set on risk management. So that will be this Armagh-Gauge and the Kalman filter to filter out the volatility and to compute value at risk. Yeah, so it's really something that is highly relevant in industry. And that will then also be due 2 weeks later. And the week after, again, we are reserving the Python focus session to help you. Yeah? But the help will already be when the problem set is handed out, but also 1 week later. Okay, and that's kind of the process we are continuing. And then the other problem set will be on option implied information. I've talked about that already. So you will learn how to extract the option implied variance that we will teach in the tutorial, in the Python focus session. Then you have a problem set to redo that for skewness. Yeah, but we provide the formulas and the like. And this is problem set 3. In problem set 4, you get then a subset of option implied information, and you will be asked to do long-short portfolios. That's what hedge funds are doing. So they try to go long what they think are the winners, go short what they think will be the losers. There will be diversification going on because you do it not stock by stock, but on a portfolio level. And you will do the same based on the option implied features that we provide you. Kind of you will ask, if I invest into firms with a high probability of a crash, will I learn and will I earn a lot or will I lose a lot, or is it not significant? That might be one of the questions. Another group might have option implied skewness. If you have firms with higher option implied skewness, do they over or underperform relative to firms with low option implied skewness? Yeah, so, and based on that, this will be big data sets. So the PhD student who works on that comes in, he shares his own code base with you. So we are not holding back, we are very generous. And part of the code is erased, and your task is then kind of to fill it up. Then we have one problem set on intraday events. So you will work with high frequency data. So these are 30-minute option implied information. There is no research on that yet. We are working on several projects on that. So you see already in this KIT bachelors how close you get to the research frontier. And we will also again provide you with code because we have a project which we want to publish very soon. We've been working on that with students in the master's research module, and it has been successful. And then we bring that knowledge, that code, that data into the course and ask you there also to learn by do. And it will be interesting to you. So you will we will ask the question, we have this option implied information, and now the question is there any information in that? Right? Of course, by then we know, does it predict returns, yes or no? But still, we would like to understand more about that data, and we will therefore confront these option implied 30-minute information with economic announcements that happened within that 30-minute interval. So that analysis can also be done with returns instead of our option implied information. So we do it with the option implied information. And there has been a recent paper which did that for interest rates. And they found that 50% of the variation in interest rates throughout the day, which is a lot for finance, 50%, is explainable by announcements that came in during that day. That really changed my view a bit, because when I was a student and went to the PhD, I wanted to connect the economy with finance data. And empirically, it was not successful. And now suddenly this research comes out, and it wasn't successful just for me, it was successful in the community. So therefore this paper is interesting, the way they do it, and you have to do high frequency, you have to do the real announcements. You cannot just regress something on GDP growth and inflation, this doesn't work. But if you go for announcements and you make the assumption that the price movements, the variation within the announcement interval, let's say 15 to 30 minutes, is all because of the announcement, which is a strong assumption. Yeah? But we need that assumption for identification. Then 50% of interest rate movements can be explained. For stocks it was less, and now we are doing here the exercise for the option implied measures. Okay, then there will be a problem set, which might be the most interesting one for you, although I think all of them deserve their place here. It's about supervised learning. So also a PhD will come in, an extra PhD student. She is working on predicting 30-minute option returns of the S&P 500 constituents using all types of data, including option implied information, but also stock information, bid-ask spreads, liquidity, and the like. And she's also sharing her code with you to allow you to get hands-on experience on how to estimate different machine learning algorithms with big data. Right? So this is also very cool. And then we will have a last problem set on reinforcement learning. So that will be handed out on the last day of teaching. But I think, having talked to our students in the past, reinforcement learning is something of high interest to everyone currently. And yes, it deserves it also. It connects very well back to our first asset allocation, because this is like reinforcement learning. Reinforcement learning is about optimal actions. And if we want to find a portfolio, we want to find an optimal action. Yeah? So there will be one problem set which you then just hand in mid-August, and will relate to what we are teaching there in reinforcement learning. Okay, so overall, I'm not sure you can judge or not. If I look at that as an outsider trying to, this is awesome. It's really awesome because I've never seen a PhD class who does that. And one reason is usually you start from scratch in every problem set, which here we don't do. That of course creates the feature that you stand on the shoulders of all these PhD students, and therefore you can really learn on applications which I'm sure in Frankfurt, I don't know, I mean maybe 1, 2, 3 firms are working on that, if at all, right? If you look at the hedge funds, more, and that of course is good value for your time. Now, here another summary about lecture versus the focus session. So lecture is based on the slides. And the slides, I try to put all the information relevant into the slides. I also have many boxes on the slides with arrows, which I did for you if you post-prepare or prepare the class, and I'm not there. Sometimes you look at something and you're like, what did he say there? What does this mean? I have little boxes for that. So I really tried to be extremely explicit. When I teach, I might not talk about all the boxes, because I just talk. But therefore you have the background that the box is for you for post-preparation. I will also, the stuff that I'm going to add are like anecdotes or different stories in order to make it more entertaining. If you are entertained, you are relaxed, so you learn better. I will also add jargon and code snippets. So if there's too much jargon at the beginning, let me know, so I just define everything. But every discipline has their jargons. For example, I once had a class and I talked about volatility, not being aware that for some students it wasn't clear that volatility is the standard deviation, right? If such stuff comes up, just let me know. Okay, now what I do in this lecture here is kind of the basis for the problem sets and for the quant work that you do for yourself or you do for someone else. So that's why the lecture is is very important. You can solve the problem sets without the lecture, I believe, but we will also ask you then to make a written report and the like, and I think this will then show how well you can formulate, how well you can play around with things you have been doing. Okay, what I also do, especially at the beginning, I will also have in my lecture slides some Python snippets to provide you additional exercises if you feel you need, right? That I said already in the beginning. Now, the Python focus sessions, they will focus on a few sub-problems that we believe are of high relevance in hedge fund type environments. Now, we've selected the sub-problems such that I have good trust that the horsepower that you've acquired in your KIT Grundlagenstudium, together with the Grundlagen you get in my course, can be combined, and then you can solve really big problems. Okay, and the grading, which is based on these problem sets, is all organized within the Python focus sessions. Yeah? Good. Now let me talk about the milestones of my lecture. So I basically, what I'm doing here is I go through my Excel sheet here and I try to organize it on a different metric. And this is a metric about what is a milestone. Yeah? And it helps you, if you're new to a field, to always have a perspective on what is really crucial here. So the first milestone, I just call it MBA type investment intuition. Yeah? It's really a big milestone. If you understand that well, and you then afterwards you talk to a practitioner, and independent of how much prior experience you have, the practitioner will not tell the difference. Yeah? So we talk about valuation, portfolio management, and cost of capital using the CAPM. So these are the three concepts. I've been also teaching Columbia University in the investments class. When we teach PhD classes, a mathematical version of that also shows up at the beginning. So this is the basis, basically. I also use my cases and the way I had the slides in that part. So therefore, it's really a gentle. You have to think about, I say MBA because a typical MBA class has a third of engineers, a third business econ, and a third social scientists. Right? And the idea then of an MBA investment class is to get everyone on board. And we do the same here with milestone 1. You also get an introduction into Python, but in my lecture, just by example. And then the next milestone will be to be able to implement or to use Python for an asset allocation decision-making problem. Yeah, so you will get some price data, and we convert that to returns, compute expected and variance, but it's just using sample averages at that point in time. And then we implement the Markowitz algorithm for getting the optimal portfolio. We do implement the analytical one. Then we also implement the one where we have constraints, like I'm not allowed to invest too much into something. There's no analytical solution anymore. We then do it numerically. Yeah? So it's a good way for you, step by step, to get used to or to reapply what you've learned in operations research, for example, on how to numerically optimize functions. The next big milestone, and this is what I will do in the class I've mentioned, is Python for CAPM factor regressions. Then next milestone is an entire block on risk management. So we talk about scenario analysis, valued risk, and how to forecast risk using gauge and stochastic volatility models. We also will, using Python, implement the maximum likelihood estimation and the Kalman filter. So the Kalman filter plus maximum likelihood is basically an application of expectation maximization. And if you go to a machine learning book, you see expectation maximization is very prominent. And here, I will not mention it again, most likely. It's expectation maximization. I just want to make you aware that we are using something which has a big algorithmic tradition and background if you wanted to go this route. Okay. Then the next milestone will be tradable. We have a bird's eye view onto tradable finance data. So then it's really about why is machine learning for finance data so different? I introduce you to a paper from a hedge fund who also does excellent research in the field, so you get their opinion. And then we talk about what a trader knows about spot market, forward markets, how a trader is trading interest rates versus cash flows versus volatility. So it's really an industry class, let's say. But it fits perfectly in here because you already have some exposure to Python, to the MBA intuition. You already submitted 2 problem sets, so you're already in the game right now, and then I think you will appreciate it very much. I also quickly then talk about, we have access to Deutsche Börse R7 platform, so it's basically allowing us to access order book information on anything that's traded on Deutsche Börse. So this is huge. We haven't yet used that in our research, since we are right now focusing on American data, and working with order book data is another dimension of increase in data volume than if you work on a 15, 30 minutes or 1 minute basis. But if we wanted to, we could see everything basically. If we had more time, I could also show it. Maybe I do it, maybe not. For now, I don't plan, but I give you some background. Now, the next upcoming milestone will then be, how can I extract predictive signals from options? I've mentioned that. So for sure, if you are running a trading strategy on stocks, you're not yet exploiting that information. So we're using that. We are, we also have I call it a case study. So there's a policy paper of the ECB about COVID. They did that right after COVID to evaluate how well did the measures that the ECB put in place help to smooth the variation in the market because of COVID. And what they do is they look at these option implied information, like the variance. So you see it's, and Madame Lagarde, she's reading that most likely as well. Right? So you really see that the policy people, they know that stuff if they're really good. If not, I'm not sure she's reading. I think she reads it because she wants to know how well her policies does. For understanding it, she has someone then below her, so on and so forth. Yeah? But we are going this way here. And then we have another milestone where we go more into detail. So I will talk about how we did build our big database based on these option implied densities. So basically, in a very short form, we've been doing research on how can we extrapolate these option prices in a highly accurate way. We've also published that and shown it's more accurate than the volatility smoothing approaches that are sold in industry. And what we've then done on top is we've been checking all the top A publications who are using option implied metrics, and we've implemented that in a fast way. And that kind of now allows us, for example, to scale our research into the 30-minute intervals, which usually no one is doing. So it's a modularization which we've done, and now we can benefit from it. I've talked to someone in industry who's head of research for asset management in a very prominent firm, and he said they would never implement that themselves because you put someone on it and it will be wrong. And this is just also our experience. So the input data, it's hard to get it, but we just have it. It has taken us 10 years. And we are not yet completely there where we want to be, but we can, everything is in reach. And therefore you can see from your Python focus session, you're kind of the first cohort to really benefit from it. Okay, and then we have some other milestones about artificial neural networks. So we just talk about the concepts, how to train them, and then we make an application where I give you option prices, and I just ask you to predict what's the price next period. And we will do that using TensorFlow, Keras, and sklearn. Now, given I give you option prices, then the next natural step will be talk about some key insights of the Black-Scholes model. Yeah? If you have these key insights, I think every door in the hedge fund industry is open for you. Then we make a second application where we predict using artificial neural net the implied volatility next period. What is implied vol? Once we are in the course, in that point, you know it. And then we talk about what do traders know about. Oh, I see. So the milestone 9 is about analytical insights. And here it's more maybe practical insights. What would a trader know about the Black-Scholes model? Yeah. So we go about how to replicate the option. There's a martingale pricing approach. In Professor Ulrich Homburg's class, you have a full semester on that. Yeah? So everything here is very dense. Then we have something like a vol skew. Why is that? What does it mean? We talk about the Greek. So how you as a private investor, how can you hedge your options? Because I know investors are trading options. And then milestone 12 will be on the machine learning portfolios. So you will kind of understand by then what the literature is right now. These are top publications of top researchers, and we talk about what they do and what they find. So now the Python focus sessions, they have basically two purposes. One thing is they will focus on selected topics. You think about that being the problem sets. And then they provide you pre and post guidance on how to solve that. And second, they also have time and space for your own questions that you have. Good. If you want a guest speaker, then I try to get one, and the guest speaker would be for a specific section of the tutorial, and then we would allocate him or her also into this part. My lecture time is too precious, but that's why for the focus session there we could do it. Now you have to think about that teaching code that you get in any type of class is not optimized for big data applications. Because if you optimize it for big data applications, then 6, 7, 8, 9, 10 lines of code, suddenly we get like a 35. So there's so much going on which we don't need to go to the heart of the problem. And that's why we have these Python focus sessions and the problem sets, which are taken from what PhDs are working on. So they are really working on big data sets, and that's why you get this code infrastructure, and then you're doing bits and pieces there to complete everything. Right. Okay. So what the Python focus session is looking at, first is, if you want, you can argue it's about numerical optimization, because we will optimize the likelihood, we will optimize the objective function of a mean variance investor. Then we move on, something more, I think the buzzword could be empirical asset pricing. So you will learn how to extract features from options. And you will also do portfolio sorts using a big data set. And then we kind of move what would be more, would have the term of financial machine learning. So we then move on to, or the Python session moves on to supervised learning, kind of predict the equity premium with machine learning methods. We will also learn the option pricing model. I do that in class. Then we have more of an economic section here in the Python. It's about do economic events like the announcement of changes in interest rate, change in inflation, whatnot, does that affect price variations? So we will look into that, gives you exposure to event studies. If you think about hedge funds, they enjoy trading on events, because if there's an event, there's news coming in, and if there's news coming in, there's high uncertainty before. So entropy is high, and you can make a lot of money in these moments. For example, we had a research paper that the ECB announcement, once there is an announcement, the market goes up, it was significant. And then I just bought 2 futures on the Euro Stoxx 50 to trade on it. So I had to, the Euro Stoxx was at 3,000 roughly. The futures is 10 times the underlying in terms of leverage. So I think the big message is I had to put up initial margin of like 6,000, and my trading position was maybe 20 minutes. I mean, I just bought 1 hour prior, I believe. I have to double check. And the event came out, the news came out, the price just jumps. There's no way you can trade in that second because no one's trading. So it's really like a coin toss. And So it just jumped, and I made on that one trade, because I then did sell it, I made 6,000. And it's just what was the futures. So I just speculated on the direction, or not say speculation. Statistically, I had a reason to believe it goes this direction. Now, if I had bought the index itself, I would have made 2%, because then the index, I think, jumped by 2%. Yeah, so 2% of 10,000 is, I don't know, maybe 200. So you see why options, futures, that is a different class. It's a different animal. Why do I mention that? Because economic events. So events are very interesting from a trading perspective. And as an academic, it's also interesting what's the information revealed here. Okay. Some strategic considerations that I put up. It's my view. Everything I'm saying here is my view, of course. So machine learning applied to finance data is one of the most challenging but also rewarding applications. Just the other day, I talked to a machine learning professor from visual graphics. So he was not trading anything, so it was interesting. These people exist. And so we had lunch, talked, and then he said, how can you ever make a good prediction if you don't model the humans in that? And I said, that's exactly why I first want to also understand how the machine learning works in disciplines where the human element is away. Yeah? For example, if I try to predict based on pictures and the like, the picture doesn't change by me making a better prediction, right? If someone has the task, draw a cat or draw a dog, and I tell him, wow, my prediction gets better and better, and he would not start suddenly to draw a refrigerator or something. Now in finance, it's different. If you learn, for example, now that these option-implied predictors are really useful, you trade on it. If you trade on it, let's say you're buying, it means the price goes up. Already now you're changing the data generating process. Now, someone else is then discovering the same thing, is also trading on it, right? And then suddenly that pattern disappears. So we have this problem here in finance that the data generating process is affected by us, by our innovations themselves. So it's really challenging because we have to adjust classical machine learning approaches to work in these fields. And I think that's the reason why these, like machine learning has only took off maybe 2020 in research. So we are very at the beginning right now. But I think it will make also contributions to other fields because of that aspect that we need to model or to account for this additional degree of complexity. Now, the data we have and you are using in the problem set, I view that as comparable what high-end hedge funds are doing. They don't tell me what they have. I have to make my own extrapolations based on talks. So that's just my opinion. What we also do is we bring students to the research frontier in terms of skill and know-how. That's also specific to our teaching and our way of teaching. So we start with the basics, but then we also, in a smart way, move on to topics that push you to the frontier. And even if you're not interested in research, if you go to industry, they are looking for people who are aware of that and who can work with that. And there will be very few people who can work with that because universities don't teach it, right? So where do you learn it? Okay, so here's just an example. I'm not sure my internet works here. Perfect. I thought so, but of course I need to maybe just make my hotspot. Failed. I'll make it a bit smaller. Okay, but anyways, you can check that at home. So this is the reference to one of the research papers we did right with a student. So he also was a bachelor student at KIT, then went into a master's. And within his master thesis, we worked on validating our methodology for constructing these option-implied surfaces. So he worked with 500 million data. It's published in a top journal, in an A journal for derivatives. The publication was also pretty easy because we had another paper already, and we refined the methodology a little bit, but what that paper here was about was the big data. So the student worked with 500 million prices and validated each of them. So we did provide the predictions coming from a C++ pipeline, and then the student built a Python pipeline for the valuation. It was really well how everything worked. And then he went on to BCG in Switzerland in the data science team. Now, okay, the internet doesn't work here. It's a pity. On the other hand, in general, what we observe is that alumni we have, especially on the more senior level, they just usually are not, it's not, let's say someone going to these cities is not the norm, yeah? It's still an outlier, I would say, in terms of probability. But we had these cases where people say, I go to London because of family reasons, and they got a job, Barclays International Quant Asset Management Research, which is difficult to get, of course. You're competing against the world, against all types of disciplines who move into finance. Just very recently, we have a student, he also family related. He had to go to New York and find a job, and now he starts at Morgan Stanley, which is also a big success. And we have many others who try to stay in Frankfurt. So they are in all types of positions, quant asset management, quant risk management, or whatever they want. The same for Zurich. Yeah. So here's from the student to New York. I got the email in March, so I thought I'd bring it up here. Again, it's about providing information of what you learn in the course. So he was just saying, hi, I'm thrilled to share. I joined Morgan Stanley in New York, so the brackets I added. Your classes truly prepared me for the interviews. So therefore, again, I encourage you as we move on to talk, not privately, but kind of, if you have questions, anything, let us discuss about these things together. And then he says, our project, the master thesis, provided me with a lot to discuss with the interviewees. Topics ranging from factor models, we have it in class, stochastic discount factor, even that we have in class, and machine learning were part of the conversations, and the way you taught us about these subjects gave me the confidence to speak about them. Yeah? So I kind of like that. It was unexpected, this email, because I mean we've been talking quite a bit, but then he still sent the email. And what I like about that is to encourage you that even though you know something, you might not be able to communicate it well. So that is a sender-receiver problem, right? So if the message is not well received, then it's like it's not a good message. But the way we structure the class, also the problem sets, with having you make then also a write-up of what you've done and prepare a presentation, and then we pick someone who holds the presentation, so on and so forth. It gives you opportunities to learn all of that. So that in an environment where you don't speak the language, it's not your first language, English, most likely, then not clear how many finance courses you have had, you still can master quite a bit, right? If you're following our structure. Now, again, which is in the motivation part. So the module is, like every module has connections to something else. So what are the connections here? I just put up the connections within the research we are doing. So routes that open up, yeah, it's like a call option, because we will start a new module in winter, which will be a research module like we had in the masters, and we still have it in the masters, but we also now bring it to the bachelors. But we will make a prerequisite. People have attended this course. So you can think about, it's like, if you go through these problem sets, each of these problem sets could have easily been a project if we didn't give the code to the student, right? So therefore the project is very easy after the course in a way, because you're well equipped, you know which field do you like, and then you can make a suggestion of what you would like to work on. We make also big groups here, 3 to 6 students. We try to also merge that, and so on and so forth. Of course, bachelor thesis also is, I think you can write a very good bachelor thesis after the course, also in this field. What we usually do is we are, sorry, we are connecting someone who writes the thesis with the PhD student. So the supervision is very close, and we aim for a joint publication. It doesn't have to be a publication at the end, but if you have that aim, then at least you know PhD is interested in it, and we are really working on something which will then be of interest to industry. Then in the masters, we have a project module. So we will not have a lecture module. I've mentioned it in the beginning. And then we have the master thesis. And we also introduced a part-time or full-time PhD program, where now at KIT we can also write cumulative dissertations. So you can write, like in your projects and problem sets, team up with someone, write papers together, and if the quality and the breadth is big enough that research counts then as a dissertation. So I think it all starts with this FDS course here. And then there's something, but I can't go into the internet, which is a pity. So do that at home. It's interesting. My argument is that quant finance, and that's what we're doing here. On a data perspective, it's attracting top talent, and top talent is expensive, but these employees, they are also willing to pay. Right? So I found I took 3 quotes, maybe just from the name. What's that saying? Why quant finance is leading the future of investment strategies. So it's exactly kind of trying to talk about why what you will do in the problem sets will in 10 years be, in 5 to 10 years, will be the status quo in the investment industry, because right now it's not yet. Then we have a second link which I found of interest. It's quant analysts. Okay, I forgot what that is about. It's the careers. No, that's also interesting to read. So I think they talked about the median salary at Google, I think was 240,000. And in these quant asset firms, it's maybe 220,000, right? So you kind of see already, we all know there are very bright minds at Google. But in these top quant firms, they have top minds as well, and they also pay them very well. And then I see, but this link is interesting, I think, the second. They also talk about what do you have to bring in order to get these jobs. Right? They talk about, you have like a quant degree, I think you're all in that field, so that's really great for you. And then they want many of these positions, like with this high median income, is having a PhD in the quant field, be it like quant finance, like we do it, or statistics, mathematics, or the like. Right? So it's a very knowledge-driven field. So there's something you might not be aware of. When I was a student, also no one told me. When I was in New York, I will show anecdotes here and there, but you kind of see there are some top quant funds in the US, and that basically these are former professors at top universities. Also, when you think about Renaissance technologies, these are like the top academics. They all have a PhD somewhere, and then they bring that knowledge into confronting it with data in a way no one else has done it before. Try to find something first and exploit that. So I think, the second, I recommend reading just to think yourself about, if you wanted to go into such a field, to know which qualifications you would need. And then the last link, it's about what, if you are one of the lucky guys who makes up their own hedge funds and are really successful, here they are just showing what these guys earn. It's not what the hedge fund earns, but what the owner earns of the hedge fund. So you have I forgot, because these are numbers which are above my pay, but it's like then 20 billion per year. Even if it's 2 billion, I think this is quite a big number. So finance is not just academically very exciting, also in terms of what you can do with that. It's very rewarding. Okay, now I say a few sentences to the PhD. We have 15 more minutes to go, and then I think I will finish up the motivation part. Now, I invite you to have a look at the page. In general, I try to keep our website up to date, so have a look there. So we have a PhD training group for artificial intelligence on business and financial market investigations, and there are fast-track options which are of interest for KIT students. Before I talk about them, so we have some mandatory coursework, and this class is part of it, is mandatory. Then the research module would be also part of it. And then we have in our PhDs, we have like weekly reading discussion groups where we talk about these new papers, which we can also bring to teaching, so we try not to hold back. And then we're also introducing kind of problem set based classes. So we have a few problem sets on, for example, software engineering right now. I'm also doing that, so we are refreshing C++ coding, how to write good codes, and then we use the language here, C++, to do that. And we will then also do the same for machine learning database, parallel systems. Because when you think about, or when you see the way the PhD students are implementing their big research topics, they all work on, at the end of the day, of Linux clusters in a parallel way. They're working with Python and with C++, and so we are plugging into the coursework, and there's some voluntary coursework. And what I want to mention is the fast track option is, I'm not sure you are aware of it, if you belong to the 95th percentile in your bachelor's at KIT, you can directly start with the PhD. Why is that of interest? If you read this second bullet point here, which I couldn't open up, right, you just see that for these really quant positions, they favor a PhD. And what I know from the US is that after this was really new to me, because we are used to the diploma. I'm not sure you, I need to talk to you, but I'm from the older generation now. So I come from the diploma, and diploma is something like the master's. But the international thinking is different. The international thinking is the bachelor's is your degree, boom. And then in the US, they all go to work. Now, if they do a master's, they do it like in law. There's a master law. They go to medical school. They go to, what is it? Medical, law. I forgot. Maybe journalism or something. Yeah? They call it like the three professions. If they really want to do something research-oriented, they directly go to the PhD. And like I have a relative, he did the same thing. He had a bachelor's computer science from a different country, and then directly went into Saarbrücken, and they have a PhD program. Some can directly start with the PhD, and then he now finishes up the PhD. So some programs give you the masters next to it, others don't, right? So in Germany, that is not yet the norm, but it's going towards that. And so I thought about these fast track options because I think there's something I call option 2, the integrated fast track. Let's maybe talk about, integrated fast track. I'm right now talking to different computer science departments Germany-wide, because everyone has different Prüfungsordnungen. There are some where you can just start after the bachelor's into the PhD and make a few applied computer science courses, which I think we could merge with our finance courses. So I think that's an interesting avenue, but that's something for the future, but at least the talks have started. For the KIT, if you think about it, if you start with this module, you will be, the anticipation would be at the end, you will be exceptional. Because you've gone through all that you needed to go, you learn from the PhDs, the code they give you and the like, you learn from me how to interpret things and the like, so I think you are really ready. And then I think the quality of bachelor thesis is already that we can try to make a paper out of it. The paper is not perfectly the bachelor thesis, but therefore this is good for you, right? Because you cannot hand in a bachelor thesis and a research paper. But if the research paper is something on top of that, something different, then this counts for the portfolio you need for a PhD. And the same then for the master's module and the master thesis. So kind of my own prediction would be, if one wanted to focus on the classes that we offer after the FDS class here, then the median student might need another year after the master's to finish the PhD. Right. This hasn't been possible in the past, because in the past we had to do a lot of groundwork. And the groundwork, there were no shortcuts. But now, given we have these big data sets, and there are so many algorithms out there one can use for predictions and the like, now it's really possible to go fast here. Okay. This was, I wanted to talk about the motivation for the class. And now for the rest of today, I will talk about valuation, interpreting regression tables, and give you one example to get started with Python programming for financial applications. Okay, so we're basically going to milestone 1 in this section of MBA, Investment Intuition. And I give it a fresh look. Yeah? Fresh look just has to say I don't assume any prior knowledge. You most likely have seen it, BWL Grundlagenprogramm, but I don't mind, I don't care. So I did ask via Ilias, you read through the case study, because I don't have time to spend a full day on it, which of course for the MBAs, that's what we do. But I give you the highlights, which is enough, even if you are unprepared. So first of all, there's an Economist article, which I also did post. It's from 2011, but the question it raises was raised 200 years ago, thousands of years ago. It's also raised today, right? It's this never-ending question about is now a good time to invest? So it's interesting to read the paper, the article, because it's a journalist who wrote that, but the journalist already wrote pretty well. And there are some things I marked in red, which I liked especially, and I will use it for my teaching. So the journalist wrote, it is an inexorable logic. The lower the yield on an asset to begin with, the lower the likely long-term return. Yeah, so it's a very strong statement, because there's no proof, nothing. Just journalist says, if the yield, what is the yield here? We talk about that, but it's the dividend you get divided by the price. If that is low, then your long-term return will also be low. And the journalist continues and says it's a truism, so it gets even stronger. Yeah? So it has to hold that the long-term return for equity equals the starting dividend yield plus dividend growth. So we have two questions here. Why does this hold? And we also have the point here that why would a rising dividend yield predict higher expected returns? Now, what the Economist article also provides is it looked from 1926 to 2000. It looked at the monthly dividend yield. So what's the dividend that, say, BMW pays over 1 year divided by the current price? It does that for all the stocks in the US. And then it computes the subsequent 10-year return. The Economist has a typo here. Right? Here it says 10-year return, here it says 15-year. It doesn't matter for us, just a long-term return. So what it happens now, it has like 12 months per year, roughly 70 years, so it has roughly 150 dividend yield observations per instrument. And here most likely they look just at the index. And then they are sorting. They are saying, let's build a bucket where we put in 1, 2, 3, 4, 5, the lowest 20% dividend yields. That could have been 1926 February. It could also be in 1965 in March. That dividend yields were very low. They get together in this bucket. Yeah, so they construct a portfolio. And then they record what was the subsequent 10 or 15-year return. And indeed, they find a positive relationship. Yeah, they find that if you did buy in a period where dividend yields were low, the subsequent 10-year return was also low. While on the other hand, if you did buy in a period where the dividend yield was high, also realized returns were high. So we have some empirical suggestion of that what they claim is a truism or this inexorable logic seems to be true. What you also see in terms of statistics, we don't know the difference is statistically significant. That is, of course, something we would do in our own analysis. One way to do it is to run regressions and to properly specify standard errors. What I also like here, you see, you can go through that. Maybe I stop with this slide. You see the stock market return for different events. So you see like here, during the First World War, so in times of war it's bad for everyone, so especially bad for the losers. The time after the war, Germany plus 18%, while the winners of the war, US, Britain, made like 300%. You see Weltwirtschaftskrise here, which was bad everywhere, also in Germany. It had negative consequences for the political system afterwards. So you see finance is highly relevant. Then you see here the Second World War. It was okay for the other nations, for Germany who started the war and lost the war, it was not good. Japan also not good. Yeah, so, what you see is then Deutsches Wirtschaftswunder. You also see in the data, yeah, you see that 49, so let's say 4 years after the war, most likely Marshall Plan and the like was in place. Germany was kind of integrating back into the Western world. So you see the Wirtschaftswunder, yeah, 4,000% within 10 years. Also Japan, yeah. So I think countries had to be reconstructed, blah blah blah. Okay, then you see here maybe you see the .com. 1990, yeah, was 100% within 10 years. I mean, it's not that much in a way. It's just 11% per year roughly. And then you have the financial crisis, 2008, where you lost 43%. In Germany, worldwide, you lost 40%. And that's within a year. And so you see already that returns are most likely not Gaussian. And we move forward in this direction, because if you just lose, I mean, we have to check the data for that. But I think the main message is more, it's interesting that returns are not completely coincidence, right? There's no causality definitely here, so on and so forth, but it's just interesting how these political, historical regimes feed back into prices. Good, I think we have a break, and then we continue.